Why some businesses survive and others fade away in the long history of investing. One question has quietly shaped more fortunes than almost any other. Why do some companies endure while others disappear? Why do certain businesses survive recessions, competition, and technological change, while others, once admired, slowly fade into irrelevance? Benjamin Graham believed the answer lay not in excitement or innovation alone, but in something far more subtle. A durable competitive advantage today. This idea is often described as an economic moat. What an economic moat really means: an economic moat is not about size, it is not about popularity, and it is not about short-term success. An economic moat is a company's ability to protect its profits from competition over time, just as a physical moat protects a castle from invaders. An economic moat protects a business from rivals who want to take market share, reduce margins, or imitate success. Graham understood that competition is relentless. If profits are attractive, competitors will come. If a company cannot defend itself, those profits will disappear. Why competitive advantage matters more than growth. Many investors focus on growth. They ask, how fast is revenue increasing? How quickly is the company expanding? Graham asked a different question. How sustainable are those profits? Growth without protection is temporary. Competitors copy products, prices fall, margins shrink. Only companies with moats can grow without destroying their own profitability. This is why Graham valued durability over speed. The market's short memory markets are often obsessed with the present. They reward current earnings. They celebrate recent success. They extrapolate today into tomorrow. Graham warned that this mindset ignores competition. Most businesses enjoy periods of strength. Few maintain them. An economic moat explains the difference. Why downturns reveal the truth. Economic downturns are brutal and honest. They expose weak balance sheets. They reveal fragile business models. They punish companies that depend on favorable conditions. Graham observed that companies with competitive advantages survive downturns better. Their customers stay loyal, their margins compress less, their cash flows remain resilient. Moats matter most when conditions worsen. Temporary success vs enduring strength. Many companies appear strong during expansions. Demand is high, capital is cheap, mistakes are forgiven. But when conditions tighten, only businesses with true advantages endure. Graham believed investors should prepare for adversity, not assume prosperity. Economic moats provide that preparation. The difference between popularity and protection. Popularity attracts attention. Protection preserves profits. High-growth companies can be popular without being protected. Graham warned investors not to confuse the two. A business can dominate headlines and still lack a moat. When competition arrives, popularity offers no defense. Why? Graham focused on business strength, not story. Graham was skeptical of narratives. He preferred evidence. He asked, can competitors easily replicate this business? Are customers loyal or price sensitive? Does the company control something scarce or difficult to replace? These questions reveal moats. Stories do not. Competitive advantage is not obvious at first. Some moats are invisible. They exist in cost structures, customer habits, distribution networks, regulatory environments. Graham understood that the strongest moats are often the least glamorous. They are built quietly and defended relentlessly. Why most companies do not have moats. Competition is the natural state of markets. Most advantages are temporary. Technology changes, consumer preferences shift, capital flows freely. Graham believed investors should assume no moat unless proven otherwise. This conservative assumption protects against disappointment. Moats reduce risk, not guarantee success. An economic moat does not eliminate risk. It reduces it. Graham never believed in certainty. He believed in probability. Companies with moats have higher odds of survival, especially during stress. That matters enormously to long-term investors. The investor's perspective. From an investor's point of view, economic moats do one crucial thing. They stabilize future earnings. Stability allows valuation. Valuation enables rational investing. Without a moat, future earnings are speculative. Graham avoided speculation whenever possible. The different types of economic moats. How companies defend their profits. Benjamin Graham understood that competition is not an occasional event. It is a permanent force. Whenever a business earns attractive profits, competitors are drawn toward it. They copy products, They lower prices, they seek efficiency over time. Competition erodes excess returns. An economic moat exists only when a company can resist this erosion. But moats are not all the same. Some are visible, others are subtle, some are built intentionally, others emerge slowly over decades. Understanding the different types of economic moats allows investors to distinguish between temporary success and enduring strength. Cost advantage. Winning by being cheaper, one of the most powerful and enduring moats is cost advantage. A company with lower costs can undercut competitors, maintain margins, or survive downturns better than rivals. Graham viewed cost advantages as particularly resilient because they are difficult to replicate. Lower costs may come from scale, superior processes, access to cheap inputs, logistical efficiency. Competitors can copy products, but they cannot easily copy cost structures during economic stress. Cost leaders often emerge stronger, while weaker competitors retreat. Cost advantage is quiet but relentless. Switching costs. When leaving is painful. Another powerful moat is switching costs. Switching costs exist when customers face inconvenience, expense, or risk by changing providers. These costs may be financial, operational, psychological, time-related. Graham understood that customers value stability. When switching is difficult, customers remain loyal even if alternatives exist. This loyalty stabilizes revenue and protects margins. Switching costs often deepen over time, strengthening the moat rather than weakening it. Intangible assets, brands, trust, and reputation. Some moats exist in the mind rather than on the balance sheet. Brands, reputations, and trust can create powerful competitive advantages. Graham was cautious with brand value, but he recognized its importance when supported by consistent performance. A trusted brand reduces customer uncertainty. It allows pricing power. It lowers marketing costs. It creates repeat behavior. However, Graham warned that brands must be earned continuously. A neglected brand can erode quickly. Network effects. Strength through participation. Talk effects occur when a product becomes more valuable as more people use it. Each new participant strengthens the system. Graham recognized that network effects can create formidable moats, but also warned that they must be analyzed carefully. True network effects are self-reinforcing. Weak ones are fragile. When genuine, network effects increase switching costs and discourage competition. When superficial, they vanish under pressure. Regulatory and legal advantage. Some moats are protected by law, licenses, patents, and regulatory barriers can limit competition. Graham treated these advantages cautiously. Legal protection can be powerful, but it can also expire or change. Investors must ask, how long does this protection last? Is it defensible politically? Does it depend on favorable regulation? Regulatory moats are strongest when they align with public interest and necessity. Efficient scale. When markets support only a few players in some industries, the market naturally supports only a limited number of competitors. This is known as efficient scale. Adding more competitors would reduce profitability for all participants. Graham observed that such industries tend to maintain stable margins and disciplined competition. Efficient scale discourages aggressive entry because returns would decline. This creates a natural moat. Cultural and organizational advantage. Some competitive advantages exist inside the company culture. Discipline and operational excellence can form powerful defenses. Graham believed management quality mattered, but only when supported by systems. A strong culture encourages efficiency, discourages reckless behavior, adapts thoughtfully. These advantages are difficult to quantify, but they become visible over time through consistency. Why most moats are narrow. Graham cautioned against assuming moats are wide. Most competitive advantages are narrow and fragile. Technology evolves. Customer preferences change. Regulations shift. Investors must continuously reassess whether a moat still exists. Assuming permanence is dangerous. Moats must be evaluated conservatively. Graham's approach to moats was skeptical by design. He assumed erosion unless proven otherwise. This conservatism protected investors from disappointment. A moat should be evident in stable margins, consistent returns on capital. Resilience during downturn. Stories alone are insufficient. Combining moats for strength. Strongest businesses often possess multiple overlapping moats. Cast Advantage plus switching costs, brand plus distribution, network effects plus scale. These layers reinforce one another. Graham believed layered defenses increased durability. Single source advantages were more vulnerable. The investor's task. The investor's role is not to admire moats, but to verify them. Investors must ask, how does this company defend its profits? How easily can competitors attack? What happens during economic stress? These questions reveal true competitive strength. How economic moats are built and how they quietly disappear. Economic moats are rarely created overnight. They are built slowly through repetition, discipline, and consistent decision-making. Benjamin Graham understood that lasting competitive advantage is not the result of a single breakthrough. It is the outcome of many small advantages compounded over time. Just as importantly, Graham recognized that moats can erode. Sometimes gradually, sometimes suddenly. Understanding how moats are built and how they disappear is essential for any long-term investor. Moats are built through repetition, not brilliance. Investors often imagine that economic moats arise from genius ideas or dramatic innovation. Graham disagreed. He believed that durable advantages are more often the result of consistent execution, disciplined capital allocation, conservative financial management. These qualities do not attract attention. They build strength quietly. A company that repeats good decisions year after year creates habits, and habits become defenses. Scale accumulates slowly. Scale is one of the most misunderstood sources of competitive advantage. Scale does not mean size alone. It means efficiency gained through repetition. As a company grows, costs per unit decline, purchasing power improves. Processes become refined. Competitors cannot replicate this instantly. Graham viewed scale as powerful precisely because it compounds. However, scale must be managed carefully. Poorly managed growth destroys advantage instead of strengthening it. Customer trust is earned, not claimed. Trust is one of the strongest and most fragile moats. It is earned through consistency, reliable products, honest communication, predictable behavior. Graham believed trust reduces uncertainty for customers. Reduced uncertainty creates loyalty. Loyalty stabilizes revenue, but trust can be lost quickly. A single breach can erase years of goodwill. Moats built on trust require continuous maintenance. Capital allocation shapes moats. One of Graham's most underappreciated insights was the role of capital allocation in building competitive advantage. Companies that reinvest prudently, avoid excessive debt, resist empire building, strengthen their moats over time. Poor capital allocation weakens defenses. Overexpansion invites competition. Excessive leverage reduces flexibility. Graham favored conservatively financed businesses because they survive stress better. Process and culture as invisible defenses. Some of the strongest moats are internal, efficient. Processes reduce costs. Strong culture enforces discipline. Clear incentives align behavior. Graham understood that these advantages are difficult for competitors to observe and therefore difficult to copy. They are invisible moats, but they require vigilance. Culture degrades when leadership changes or incentives distort behavior. Why moats often appear obvious in hindsight. Investors frequently recognize moats only after they are well established. By the time a moat becomes obvious, much of its value may already be reflected in price. Graham cautioned against this hindsight bias. True analysis requires identifying early signs, improving margins, stable returns on capital, customer retention during stress. These indicators often appear before public recognition. The slow erosion of competitive advantage. Moats rarely collapse suddenly. More often, they erode quietly. Costs creep upward. Customer loyalty weakens. Competitors innovate incrementally. Graham emphasized that investors must monitor rates of change, not just current strength. A slowly eroding moat can still appear strong until it isn't. Technology is a double-edged sword. Technology can strengthen moats or destroy them. It can reduce costs, improve distribution, deepen customer engagement, but it can also lower barriers to entry, commoditize products, eliminate switching costs. Graham warned investors not to assume technology always favors incumbents. Adaptation matters. Those who fail to adapt see their moats shrink. Regulatory shifts and moat fragility. Some moats depend on regulation, licensing, exclusivity, or legal protection can be powerful, but Graham treated regulatory advantages cautiously. Regulations change. Public sentiment shifts. Political priorities evolve. Moats dependent on regulation must be discounted accordingly. When management undermines its own moat ironically, success often weakens discipline. As profits rise. Companies expand aggressively, relax cost controls, chase growth at any price. Graham observed that management often destroys moats unintentionally. Complacency is the enemy of durability. The best management teams defend their moat as fiercely as they built it. Competitive advantage is a process, not a state. One of Graham's most subtle lessons is that competitive advantage is never permanent by default. It must be earned continuously. Investors who treat moats as permanent invite disappointment. Graham preferred businesses that behaved as if competition were always approaching. That mindset preserves advantage. A practical investor's question. Graham encouraged investors to ask, what protects this company's profits 5 or 10 years from now? If the answer is unclear, the moat may be weaker than it appears. Clarity matters. Economic moats in downturns. Why strong businesses survive. Economic expansions are generous. They reward almost everyone. Weak businesses survive. Poor decisions are forgiven. The mistakes are hidden by rising demand. Benjamin Graham understood that prosperity disguises weakness. It is during economic downturns that the true strength of a business is revealed. Recessions are not merely periods of lower growth. They are tests of endurance. And economic moats matter most when conditions become hostile. Downturns separate strength from appearance. In good times, many companies appear successful. Sales rise. Margins look healthy. Cash flows seem adequate. But Graham observed that these appearances are often misleading. When demand falls and credit tightens, weaknesses surface. Companies without moats struggle immediately. Customers become price sensitive. Competitors cut prices. Margins compress rapidly. Businesses with economic moats respond differently. They bend, but they do not break. Pricing power as a shield. One of the most important advantages during downturns is pricing power. Companies with strong brands, loyal customers, or essential products can maintain prices even when demand weakens. Graham valued pricing power because it preserves margins. When competitors are forced to discount aggressively, companies with moats remain profitable. This difference compounds quickly during prolonged downturns. Customer loyalty under stress. Economic stress tests customer relationships. When money is tight, customers reevaluate spending. They abandon discretionary purchases. They seek value. They reduce experimentation. Companies with moats benefit from habit and trust. Customers stay because switching feels risky. Alternatives feel uncertain. Relationships feel familiar. Graham believed loyalty is revealed during hardship, not abundance. Caste structure becomes critical during downturns. Caste structure determines survival. Companies with cost advantages can operate profitably at lower volumes. Those without are forced to cut investment, reduce quality, incur losses. Graham favored businesses with flexible and efficient caste bases. Cost advantages widen moats precisely when revenues fall. Cash flow stability matters more than growth. Growth slows during recessions. Investors who rely on expansion suffer disappointment. Graham focused on cash flow stability. Companies with moats generate cash even in adverse conditions. This cash allows them to service debt, maintain operations, invest opportunistically. Businesses consume cash when conditions deteriorate. This difference determines survival. Balance sheet strength and competitive advantage. Economic moats interact with financial structure. Even strong businesses can fail if over-leveraged. Graham emphasized conservative balance sheets. Companies with moats and low debt gain strategic flexibility. They are not forced sellers. They do not depend on favorable credit markets. During downturns, flexibility becomes an advantage. The behavior of competitors during stress. Downturns weaken competitors. Struggling companies cut corners. They reduce service. They abandon long-term investment. Companies with moats often maintain standards. This behavior strengthens their competitive position. Customers notice consistency when conditions improve. Moat-driven businesses emerge stronger. Market share shifts in crises accelerate. Change. Weak players retreat. Strong players advance. Graham observed that downturns often increase market concentration. Companies with moats gain share not through aggression, but through survival, time favors those who endure. Psychological stability and management discipline stress reveals management quality. In downturns, leaders face pressure to react emotionally. Graham favored management teams that remain disciplined, avoiding panic, resisting short-term fixes, protecting long-term value. Economic moats provide confidence. Confidence supports rational decisions. Investor perception during downturns. Markets often punish all stocks during downturns. Prices fall broadly. Graham saw opportunity here. Companies with moats recover faster. Their earnings rebound. Their customer base remains intact. Their competitive position strengthens. Valuation disconnects create opportunity for disciplined investors. The compounding effect of survival is underrated. Companies that endure multiple downturns accumulate advantages, experience, reputation, customer trust. Graham believed longevity itself becomes a moat. Each crisis survived strengthens the business. Why moats reduce permanent loss risk. Graham distinguished between volatility and permanent loss. Downturns cause volatility. Permanent loss occurs when businesses cannot recover. Reading economic moats in financial statements, what the numbers quietly reveal. Benjamin Graham believed that while stories can inspire, numbers reveal truth. Economic moats often appear subtle. They are rarely announced. They are seldom described clearly by management, but they leave traces. Those traces appear in financial statements, quietly, consistently, and over time. Graham taught investors to look past excitement and focus on patterns. Patterns in margins, patterns in returns, patterns in resilience. These patterns often reveal competitive advantage more reliably than narratives ever could. Why financial statements matter more than stories. Stories explain intentions. Financial statements record outcomes. A company may claim to have a strong competitive position. The numbers confirm whether that claim is true. Graham trusted outcomes. He believed that economic moats manifest as financial consistency, especially under stress. Is profitability stable? Do margins persist? Are returns superior and durable? These questions guide analysis. Gross margins, as the first signal. Only of the earliest indicators of a moat appears in gross margins. Gross margin reflects pricing power and cost advantage consistently. High or stable gross margins suggest strong brand, differentiated products, cost leadership. Graham cautioned investors to compare margins within industries, not across them. A moat is relative. If a company's margins exceed competitors over long periods, something protects it. Temporary margin spikes do not qualify. Durability matters. Operating margins and discipline. Operating margins reveal operational efficiency and cost control. Companies with moats often maintain operating margins through cycles. During downturns, weak businesses see margins collapse. Strong businesses see margins compress. Modest Graham valued this resilience. Operating margins that remain stable despite economic stress often signal a moat at work. Return on capital, a core measure of advantage. Perhaps the most important numerical signal of an economic moat is return on capital. High and sustained returns on capital indicate that a company can earn excess profits without attracting destructive competition. Graham believed this was critical. If competitors could easily replicate success, returns would fall. Persistently high returns suggest barriers exist, but Graham warned investors to look at long-term averages, not short-term peaks. Durability distinguishes moats from luck. Capital intensity and reinforcement of advantage. Some businesses require heavy capital investment just to compete. If returns remain strong despite this, the moat is likely substantial. Conversely, if high returns require constant reinvestment merely to maintain position, the advantage may be weaker. Graham encouraged investors to ask, how much capital is required to sustain profits? Does reinvestment strengthen or dilute advantage? Efficient capital use often signals durable advantage, revenue stability, and customer behavior. Revenue tells a story about customers. Companies with economic moats often exhibit steady revenue growth, limited volatility, resilience during downturns. Graham believed customer behavior was revealing. If customers remain loyal when conditions worsen, a moat likely exists. Revenue volatility often signals weak differentiation. Pricing power hidden in numbers. Pricing power rarely appears explicitly. It is inferred. Companies with pricing power can raise prices without losing volume, maintain margins during inflation, pass costs to customers. Thus abilities appear in stable or rising margins despite cost pressures. Graham paid close attention to this. Inflation and downturns expose pricing power clearly. Expense discipline as a defensive trait. Companies with moats often demonstrate expense discipline. They do not chase growth recklessly. They do not expand costs faster than revenue. Graham viewed disciplined expense management as a sign of competitive maturity. Weak businesses overspend to compete. Strong businesses allow advantages to work quietly. Cash flow as confirmation. Earnings can be influenced by accounting choices. Cash flow is harder to disguise. Companies with moats convert earnings into cash consistently. Free cash flow stability signals pricing power, customer loyalty. Efficient operations. Scrum trusted cash flow as confirmation. If profits are real, cash appears. Balance sheet strength and moat durability. Strong balance sheets reinforce moats. Low debt allows companies to endure downturns. Invest opportunistically. Avoid forced decisions. Graham believed financial conservatism strengthened competitive advantage. A company burdened by debt cannot defend its position effectively. Comparing over time, not moments. Scrum emphasized longitudinal analysis. 1 year proves nothing. 5 or 10 years reveal patterns. Economic moats reveal themselves through consistency. Investors must study trends, margins over cycles, returns across periods. Cash flow stability. This requires patience, but patience reveals truth. Warning: signs of moat erosion. Just as numbers reveal moats, they also reveal erosion. Watch for declining margins, falling returns on capital, increasing customer churn, rising costs without pricing power. Graham urged investors to remain alert. Moats weaken gradually. Numbers whisper before they shout. Financial statements as a defensive tool. For Graham, financial analysis was not about prediction. It was about protection. Understanding economic moats through numbers reduces reliance on optimism. It anchors decisions in evidence. False moats and investor mistakes when competitive advantages. An illusion. Known of Benjamin Graham's greatest strengths was his skepticism. He did not assume strength. He demanded proof. In investing, many perceived economic moats are not real. They are temporary advantages mistaken for permanent ones. False moats are dangerous because they look convincing until they fail. Understanding these illusions is just as important as recognizing genuine competitive advantages. Popularity is not a moat. One of the most common investor mistakes is equating popularity with protect. In a company may dominate headlines. It may attract customers quickly. It may enjoy rapid growth. But popularity does not prevent competition. Graham warned that markets often reward novelty temporarily. Competitors respond. Attention fades. Margins normalize. Popularity attracts challengers. It does not repel them. First mover advantage is often temporary. Being first feels powerful. Early entrants gain attention, customers, and momentum. But Graham cautioned that first mover advantage often lacks durability. Later entrants learn from early mistakes. They improve efficiency. They compete aggressively on price. Unless first mover advantage creates switching costs or network effects, it rarely endures. Being early is not the same as being protected. Technology alone is not a moat. Innovation excites investors. New technology suggests progress and dominance, but Graham warned that technology often lowers barriers to entry. When innovation spreads, advantages erode. Competitors replicate features. Costs fall. Products commoditize. True moats require protection beyond innovation. Technology without defense is fragile. Growth without profitability. Typed growth often convinces investors that a moat exists. Graham disagreed. Growth without profitability attracts competition. If growth does not translate into sustainable margins, that advantage is temporary. Profitability reveals power. Growth alone does not. Graham focused on earning power, not expansion. Regulatory favor is not guaranteed. Some businesses benefit from regulation. Licenses, subsidies, or exclusivity create advantage. But Graham treated regulatory moats with caution. Regulations change. Public opinion shifts. Political priorities evolve. An advantage dependent on favorable policy is inherently unstable. True moats endure regardless of regulation. Customer inertia versus customer loyalty. Investors often mistake customer inertia for loyalty. Customers may stay because alternatives are inconvenient, not because they prefer the product. Inertia weakens when conditions change. Graham distinguished between habit and preference. True loyalty persists under pressure. Inertia does not. False moats collapse when customers reassess options. Scale without efficiency. A large size impresses investors, but size alone does not guarantee advantage. Graham emphasized efficiency. If scale does not lower costs or improve margins, it provides little defense. Large inefficient companies are vulnerable. Efficiency, not size, creates protection. High returns that invite competition. Temporary high returns often signal opportunity for competitors. If high returns attract capital easily, they will not last. Graham taught that true moats discourage entry if competitors rush in. Barriers are weak. Sustainable advantage limits imitation. Management confidence is not evident. Securismic leadership often persuades investors. Confidence sounds convincing. Graham was unimpressed by confidence without results. Leadership claims must be verified through numbers. True moats appear in outcomes, not speeches. The danger of linear thinking. Investors often assume that current advantages will persist unchanged. Graham rejected linear thinking. Markets evolve. Competitors adapt. Customer behavior shifts. Assuming permanence invites disappointment. Moats must be reassessed continuously. Overestimating brand strength. Brands can be powerful moats or fragile illusions. If a brand lacks pricing power or loyalty, it is cosmetic. Graham believed brands must demonstrate financial impact. If customers abandon a brand when prices rise, loyalty is weak. True brand moats sustain margins. Mistaking complexity for protection. Complex business models may appear defensible. Graham warned that complexity often masks weakness. If customers cannot understand the value, competitors will simplify and disrupt. Simplicity often outperforms complexity over time. The confirmation bias trap. Investors who believe a moat exists seek evidence to support it. They ignore contradictory signs. Graham emphasized objectivity. If data contradicts belief, belief must change. False moats persist because investors resist re-evaluation. How false moats collapse. False moats fail quietly at first. Margins slip, returns decline, customers experiment elsewhere. By the time collapse becomes obvious, value is already lost. Graham urged early recognition, a defensive investor's checklist before concluding a moat exists. Graham would ask, is this advantage durable? Does it discourage competition? Has it persisted through adversity? Do numbers confirm it? If answers are unclear, caution is warranted. Economic moats and valuation. Why strength does not justify any precision. Of the most common and costly mistakes investors make is believing that a strong economic moat removes the need for valuation discipline. Benjamin Graham strongly disagreed. He believed that no competitive advantage, no matter how durable, eliminates the importance of price. Economic moats reduce business risk. They do not eliminate investment risk. Valuation remains the final and decisive factor. Why great businesses can be bad investments. A business can possess an exceptional moat. It may dominate its industry. It may generate steady profits. It may survive downturns better than peers. Yet if investors pay too much, returns suffer. Graham emphasized that investment results depend on business quality, financial strength, price paid. Ignoring any one of these invites disappointment. High-quality businesses purchased at extreme valuations leave no margin for error. The compression of future retention. Investors buy moat-protected businesses at high prices. They often assume future growth will justify the valuation. Graham warned that this assumption compresses future returns. Much of the expected success is already reflected in the price. Even if the business performs well, returns may be mediocre. Strong performance becomes necessary just to break even. This is not investing, it is dependency on optimism. Moats do not prevent valuation. Gravity. Markets eventually reconcile price with value. Economic moats may slow this process, but they do not stop it. Graham believed that valuation gravity applies to all businesses. High prices imply high expectations. If expectations moderate, even slightly, prices adjust downward. Moats cushion declines. They do not prevent them. The danger of paying for certainty. Investors often pay premium prices for certainty. They believe moat-protected businesses are safe. Graham rejected this framing. Safety does not come from reputation, it comes from buying with a margin of safety. Paying too much removes that margin. Regardless of moat strength, certainty purchased at any price is an illusion. Growth assumptions embedded in price-high valuations embed assumptions, sustained growth, stable. Margins, limited competition. Favorable conditions. Each assumption increases fragility. Graham taught that the more assumptions required, the riskier the investment. Even companies with moats face uncertainty. Competition adapts, markets change, technology evolves. Valuation must account for these realities. When moats encourage overconfidence or rally. Strong moats can encourage investor overconfidence. Investors assume the moat guarantees success. They relax scrutiny. They tolerate high prices. Graham warned that confidence must be proportional to uncertainty, not reputation. Strong businesses deserve respect, not blind trust. The role of reversion. To the mean, even exceptional companies experience periods of normalization. Returns on capital decline, growth slows, margins compress. Graham emphasized reversion to the mean. High valuations often ignore this force. Investors extrapolate recent success indefinitely. Markets eventually correct this assumption. Valuation. As a second line of defense, economic moats form the first line of defense. Valuation forms the second. Both are required. A moat without valuation discipline invites overpayment. Valuation without business strength invites fragility. Graham believed intelligent investing requires both. Why waiting is especially hard with great business. Waiting for reasonable prices is difficult when businesses are admired. Investors fear missing out. They convince themselves that price no longer matters. Graham accepted discomfort as the cost of discipline. He believed that waiting was preferable to overpaying. Patience preserves flexibility. That investors' responsibility. Graham placed responsibility squarely on the investor. Markets offer prices. Investors must judge value. No business, no matter how strong, is exempt from this judgment. Paying attention to valuation is not pessimism, it is prudence. A simple Graham test before buying a moat-protected business. Graham would ask, if this company performs slightly worse than expected, am I protected? If the answer is no, the price is too high. Moats are not permanent. How competitive advantage evolves over time. One of the most subtle dangers in investing is the assumption of permanence. Benjamin Graham repeatedly warned investors against believing that today's strengths will automatically exist tomorrow. Economic moats are not static structures, they are dynamic defenses. They expand, they weaken, they adapt, or they disappear. Understanding how moats evolve over time is essential for protecting capital and preserving long-term returns. The illusion of permanence. Investors often treat successful businesses as fixed monuments. They assume that dominance today implies dominance forever. Graham rejected this thinking. Markets change, technology advances, customer behavior shifts. A moat that is strong today may be narrow tomorrow. Assuming permanence invites complacency. Competitive pressure never stops. Competition is relentless. Even when a company appears unchallenged, rivals are learning, copying, and experimenting. Graham believed that competitive pressure operates continuously, even when it is invisible. Companies that stop defending their position gradually lose ground. Moats must be reinforced deliberately. The role of incremental erosion. Moats rarely collapse suddenly, they erode incrementally. Margins narrow slightly, customer loyalty weakens quietly, costs rise subtly. Each change appears insignificant in isolation. Over time, the cumulative effect becomes decisive. Graham emphasized the importance of monitoring trends, not snapshots. Innovation as both threat and defense. Innovation can strengthen a moat or undermine it. Companies that innovate to improve efficiency, customer experience, or cost structure reinforce advantage. Companies that ignore innovation invite disruption. Graham cautioned investors not to assume incumbents will always adapt successfully. Adaptation requires discipline and humility. When scale becomes a burden, scale can be a powerful moat, but scale can also become rigid. Large organizations may struggle to change processes, culture, or priorities. Graham observed that flexibility matters as much as size. Smaller competitors can exploit rigidity. Scale must be paired with adaptability to remain a defense. Cultural decay and moat weakening. Organization culture is fragile. As companies grow or leadership changes, Discipline can erode, incentives may shift toward short-term results. Risk-taking may increase, cost controls may weaken. Graham believed that cultural decay often precedes financial decline. Investors who ignore culture miss early warning signs. Capital allocation as a signal of moat health. Though a company uses capital, reveals management's confidence in its competitive position. Wise reinvestment strengthens moats, reckless expansion weakens them. Graham encouraged investors to watch capital allocation carefully. Overpaying for acquisitions often signals overconfidence and declining organic advantage. External forces that reshape moats. Some changes are external. Regulatory shifts, technological breakthroughs, changes in consumer preferences. These forces can reshape entire industries. Graham advised investors to ask, is this moat dependent on conditions that may change? How adaptable is the business model? Moats that rely on static environments are fragile. Customer behavior as the ultimate test. Customers reveal moat strength through behavior. Do they stay when prices rise? Do they remain during downturns? Do they recommend the product? Graham believed customer behavior offers the clearest evidence of competitive advantage. Numbers follow behavior. The danger of narrative drift as moats weaken. Narratives often become more elaborate. Management emphasizes vision rather than results. Investors focus on future promises. Graham warned that expanding narratives often compensate for shrinking advantages. Reality does not require persuasion. Continuous reassessment is not optional. One of Graham's most important lessons is that investing is an ongoing process. Moats must be reassessed regularly. Assumptions must be tested against evidence. Investors who fail to reassess become attached to outdated beliefs. Attachment increases risk. The investors' discipline. Graham believed discipline meant being willing to change one's mind. Selling a business whose moat has weakened is not failure. It is responsibility. Protecting capital requires humility. A practical monitoring from work. Graham would encourage investors to track long-term margin trends, returns on capital, customer retention indicators. Competitive behavior. These signals reveal moat evolution early. Economic moats and portfolio construction. Building for endurance, not excitement. Benjamin Graham believed that investing was not about assembling a collection of exciting ideas. It was about constructing a portfolio that could endure uncertainty. Economic moats play a critical role in this process. They are not merely characteristics of individual companies, they are structural elements that shape how a portfolio behaves over time. Understanding how to incorporate moats into portfolio construction transforms investing from speculation into stewardship. Why portfolio construction matters as much as stock selection. Many investors focus exclusively on choosing stocks. They search for the best ideas. They chase superior businesses. They attempt to identify future winners. Graham believed this approach was incomplete. How investments interact within a portfolio matters just as much as their individual qualities. A portfolio of strong businesses can still fail if it lacks balance, valuation discipline, and resilience. Economic moats contribute to portfolio stability, not just individual success. Moats reduce portfolio fragility. Fragility arises when outcomes depend on favorable conditions. Portfolios dominated by businesses without moats require continuous growth, favorable markets, sustained optimism. Graham warned that such portfolios perform well only when conditions cooperate. Companies with economic moats behave differently. They generate cash consistently. They retain customers. They protect margins. This behavior reduces portfolio fragility. The role of moats in risk management. Graham defined risk as the probability of permanent loss of capital, not price volatility. Economic moats reduce this probability. Companies with durable advantages are less likely to lose relevance, face destructive competition, collapse during downturns. Including such businesses in a portfolio lowers the risk of irreversible damage. Volatility may still occur, but recovery becomes more likely. Concentration versus diversification through the lens of moats. Graham was cautious about excessive concentration. He believed that no analysis could eliminate uncertainty entirely. However, he recognized that diversification across similar fragile businesses offers little protection. Economic moats change this calculus. A portfolio diversified across businesses with different types of moats, cost advantage, brand strength, switching costs. Efficient scale creates resilience. Each moat responds differently to economic stress. This form of diversification is structural, not superficial. Avoiding overdependence on one moat. Type investors sometimes focus too heavily on one type of competitive advantage. They favor brands or networks or scale. Graham encouraged balance. Moats fail in different ways. Regulatory moats may weaken due to policy changes. Technological moats may erode due to innovation. Brand moats may fade if trust declines. A portfolio that includes varied moat types reduces exposure to any single failure mode. Moats and cash flow stability. From a portfolio perspective, cash flow stability matters enormously. Companies with moats produce predictable cash flows. These flows support reinvestment, fund dividends, cushion downturns. Graham valued this predictability. It allows portfolios to withstand stress. Without forced selling, unpredictable cash flows introduce fragility. The interaction between moats and valuation in portfolio 7. The strongest moat cannot justify extreme valuation. Graham emphasized that portfolio construction must balance business quality, competitive advantage, price discipline. A portfolio of moat-protected businesses purchased at excessive prices remains vulnerable. Valuation provides the margin of safety. Moats enhance it, they do not replace it. Long-term holding and behavioral stability. Portfolios containing moat-protected businesses are easier to hold. Investors are less tempted to trade. They tolerate volatility better. They resist panic. Graham believed behavioral stability was critical. Frequent trading increases errors. Moats support patience. Reinvestment and compounding at the portfolio level. Economic moats enable internal compounding. Companies reinvest profits at attractive rates. This compounding occurs without constant portfolio adjustment. Graham understood that time amplifies the effect of durable advantages. Portfolios built around moats benefit from quiet compounding. The role of moats in defensive investing. For defensive investors, moats are especially valuable. They reduce the need for precision. They tolerate conservative assumptions. They offer protection during stress. Graham believed defensive investing was about reducing exposure to unfavorable outcomes. Economic moats support this goal. Portfolio turnover and moat durability. High turnover increases costs and errors. Graham favored low turnover, durable moats justify longer holding periods. This reduces transaction costs and behavioral mistakes. However, durability must be monitored. Holding is justified by evidence, not habit. Avoiding narrative-driven portfolio construction. Portfolios built around stories are fragile. When narratives fade, confidence collapses. Graham urged investors to base portfolios on fundamentals, not themes. Economic moats provide a fundamental anchor. They persist beyond narratives. Stress testing the portfolio. Graham would encourage investors to stress test portfolios mentally. Ask, how does this portfolio behave in a recession? Which businesses survive revenue declines, which require constant optimism? Moat-protected businesses perform better in such tests. The quiet nature of endurance. Portfolios built around economic moats are rarely exciting. They do not always lead in bull markets. They may lag during speculative surges. Graham accepted this trade-off. He believed endurance mattered more than temporary outperformance. A portfolio is a long-term commitment. Graham viewed portfolio construction as a long-term responsibility. Frequent reinvention invites error. Economic moats allow portfolios to remain relevant across cycles. They provide continuity in a changing world. The final lesson of economic moats: discipline, humility, and long-term survival. At the end of Benjamin Graham's thinking lies a lesson that is both simple and demanding. Investing success does not come from brilliance. It comes from discipline. It does not come from certainty. It comes from humility. And it does not come from excitement. It comes from survival. Economic moats matter because they help investors survive long enough for compounding to work. Why? Survival comes before success. Graham believed that the first objective of investing was not to win, but not to lose permanently. Markets offer many opportunities, but they also impose many tests. Only investors who survive downturns, competition, and mistakes can benefit from long-term growth. Economic moats reduce the probability of permanent loss. They do not guarantee success. They increase endurance. Endurance is the foundation of compounding. Discipline means saying no repeatedly. Discipline is not about action, it is about restraint. Investors encounter thousands of ideas. Most must be rejected. Graham believed that disciplined investors say no far more often than they say yes. They reject businesses without protection, advantages that cannot be explained, valuations that assume perfection. Economic moats help investors filter opportunity. They narrow the field to businesses worthy of long-term commitment. Humility. In the face of competition is relentless. Even the strongest businesses face challenges. Even the widest moats are tested. Graham emphasized humility. Investors must accept they cannot predict all changes. They cannot foresee all threats. They will make mistakes. Economic moats do not eliminate uncertainty. They reduce exposure to it. Humility keeps investors alert. Why investors overestimate their insight. One of Graham's greatest warnings was against overconfidence. Investors often believe they understand businesses better than they do. They confuse familiarity with knowledge. They confuse narratives with evidence. Economic moats force investors to ground beliefs in reality. They demand proof in margins, in returns, in resilience. These discipline protects against illusion. Long-term investing is not passive. It is passion. Patience is often misunderstood. It does not mean ignoring reality. It means allowing time to work when conditions are favorable. Graham believed patience must be paired with vigilance. Economic moats justify patience, but only as long as they remain intact. When evidence changes, patience must give way to action. The cost of impatience destroys more wealth than ignorance. It drives overtrading, overpaying, abandoning sound businesses prematurely. Economic moats reduce the urge to act impulsively. They provide confidence grounded in structure, not hope. This confidence supports patience. Why quiet businesses often win. Most durable businesses are often unremarkable. They do not dominate headlines. They do not promise transformation. They do not inspire excitement. They simply perform year after year. Graham believed such businesses are ideal investments. Economic moats allow them to endure without spectacle. Quiet endurance outperforms dramatic ambition over time. Compounding rewards endurance, not genius. Compounding does not require perfect decisions. It requires avoiding catastrophic ones. Economic moats reduce the likelihood of catastrophic outcomes. They keep businesses relevant. They preserve earnings power. They support reinvestment. Time does the rest. Graham understood that survival is the prerequisite for compounding. The investor's true advantage. A profession. Investors have resources. Institutions have scale. Markets have information. Individual investors have one advantage: time. Economic moats align perfectly with this advantage. They allow investors to hold through cycles without constant intervention. This alignment is powerful. Why this lesson never becomes obsolete. Markets evolve, technology advances, industries change, but competition remains. So does human behavior. Graham's emphasis on competitive advantage remains relevant because it addresses permanent realities. Economic moats are not trends. They are defenses against timeless forces bringing it all together. Economic moats matter because they protect profits, stabilize cash flows,